Imagine waking up one morning, scrolling through your bank app, and seeing an extra $500 sitting there without lifting a finger. That's the magic of investing. It's not gambling, a lucky streak, or a get-rich-quick scheme. It's more like planting a tiny seed today and watching it slowly grow into a towering money tree over time. For beginners, the jargon, stocks, bonds, ETFs, can feel intimidating. But here's the good news. Investing doesn't need a PhD. This guide uses real numbers and zero fluff. By the end, you'll know exactly how to start with as little as $10. Why invest? Picture this. You stuffed $200 under your mattress today. 10 years later, it's still $200. Sounds safe, right? But inflation, the silent, creeping thief, means the same $200 won't buy nearly as much. That $200 burger you love today could cost $300 in a decade. Investing is how you fight back. Here's a real fact. From 1926 to 2023, the U.S. stock market, S&P 500, gave an average annual return of about 10% before inflation. Even after accounting for roughly 3% annual inflation, your real growth is still 7% per year. Put $5,000 in at age 25, and by 65 you could have over $76,000 without adding a single dime more. That's compound interest. Your money earns money, and then that earned money earns even more. Saving is safe but slow. Investing makes your cash work as hard as you do. Step 1. Get your money house in order first. Before diving into investing, make sure your financial foundation is solid. Investing while drowning in high-interest debt is like planting flowers in a flooded garden. They'll never thrive. Start here. Build an emergency fund. Save 3-6 months of living expenses in a high-yield savings account. For example, if your rent, food, and bills total $2,000 monthly, aim for $6,000, $12,000. Online banks like Ally or Capital One can pay 4 or 5% interest, much higher than a traditional savings account. Eliminate high-interest debt. Credit card rates often hit 20% or more. Compare that with investing's average 7-10% returns. Paying off debt first is smarter math. Set clear goals. Are you investing for retirement, a home, or travel? Having a target keeps you motivated when markets swing. Step 2. Learn the basics. Investing might seem complicated, but think of it as buying tiny pieces of companies or lending money in exchange for interest. Stocks are simply slices of a company. Buy a share of Apple or Amazon and you own a piece. If the company grows, your share grows too. Some stocks pay dividends, bonus cash for simply holding them. Risk. Prices fluctuate, sometimes wildly. Real example. Apple stock bought at $1 in 2003, split adjusted, is worth over $200 today. Bonds are loans to governments or companies. They pay you interest and are generally safer than stocks, but with lower returns, often 3-6% per year. U.S. Treasury bonds are considered one of the safest options. Mutual funds and ETFs are baskets of many stocks or bonds. One purchase gives you instant diversification. ETFs trade like stocks with low fees, 0.03, 0.5%. Vanguard's VTI ETF, for instance, tracks the entire U.S. market and historically returns around 10% per year. Index funds are cheap ETFs or mutual funds that mirror the market, like the S&P 500. Warren Buffett recommends these for beginners. Why? Most active fund managers lose to the index over a decade. Skip the hype of day trading or crypto for now. Start simple, steady, and stress-free. Step 3. Pick your investing playground. Next, you need a place to invest, and the good news is you don't have to visit a bank branch. Your phone handles everything. Brokerage accounts let you buy and sell stocks, ETFs, and other investments easily. For beginners, some of the best apps include Robinhood, which is fun, simple, and offers free trades with no minimum deposit. Fidelity, known for its educational tools and zero fees, and Vanguard, famous for low-cost index funds with many options available at $0 minimum. Retirement accounts are another powerful tool because they provide tax advantages. A 401k through your employer often comes with a match, which is essentially free money. Contribute 5% of your salary and your employer might add another 5%, giving you an immediate 100% return on that portion. Individual retirement accounts, IRAs, also help. Roth IRAs grow tax-free while traditional IRAs give upfront tax benefits. For those without a 401k, a taxable brokerage account is a quick way to start. Setup takes about 5 minutes. Step 4. Start small. Waiting to save a huge sum before investing? Don't. The key is starting now and investing consistently, even with small amounts. One simple strategy is dollar cost averaging, DCA. With DCA, you invest a fixed amount regularly, say $100 a month, into an ETF, no matter the market price. When prices drop, you buy more shares. When prices rise, you buy fewer. Over time, this evens out market swings and reduces risk. History proves the power of consistency. Investing $200 monthly in an S&P 500 ETF from 2000 to 2023, even through the dot-com bust, the 2008 crash, and the pandemic, turned $55,200 into over $150,000. Trying to time the market often fails, but steady investing wins. Apps like Acorns make this effortless, rounding up spare change and investing it automatically. Small, consistent steps beat luck every time. Step 5. Build a simple portfolio. Beginners often overcomplicate investing, thinking they need to be smart, but the simplest approach often works best. The 3-fund portfolio, popularized by Bogleheads, is a perfect example. 60% U.S. total stock market ETF for growth, 20% international stock ETF for global exposure, and 20% U.S. bond ETF for safety. Adjust based on age, more stocks when young, more bonds as you near retirement. Common mistakes beginners make. Avoid these. Market dips are normal, not the end of the world. In 2022, the S&P 500 dropped 25%, yet it fully recovered in just 18 months. Selling in fear locks in losses instead of giving your money time to grow. Patience pays. Avoid chasing hot tips. Exciting stocks can lure you in, but hype often equals risk. Remember GameStop's wild ride? Short-term thrills can mean long-term losses. For steady growth, stick to broad index funds that mirror the market instead of gambling on fads. High fees steal your returns. Even a 1% annual fee can quietly cut your wealth by about 25% over 30 years. Always compare costs and choose low-fee ETFs or mutual funds to maximize compounding power. Risks? Investing carries risks. Markets crash. Examples: 2008, minus 50%, 2020 COVID drop, minus 34% in a month. But cash loses value to inflation every year. Bonds aren't risk-free either if interest rates rise. Rule of thumb: invest only what you won't need for 5+ years. Short-term needs? Keep them in savings. In conclusion, the biggest advantage an investor can have is time. Starting early allows your money to grow exponentially, thanks to the power of compounding. For example, if you invest $5,000 at age 20 with an average 7% annual return, by the time you turn 60, that money could grow to around $70,000. Wait until 40 to invest the same $5,000, and it might only reach $15,000. The difference is time. The earlier you start, the more your money works for you. The lesson is simple. Start small, stay consistent, and trust the market. Don't wait for the perfect moment. Your future self will thank you. The best time to plant your money tree was yesterday. The second best time, today. If you enjoyed this, subscribe for more videos. Leave a comment with your suggestions. Thanks.